welcome to Harmony's Q4 and year-end results for the financial year 2014. On the highlights, year-on-year, despite the challenges of the year, we managed to increase gold production. It was a lot about reducing costs, and you'll see that there's a substantial reduction in all-in sustaining costs. There's an improvement year-on-year in grade, and we've really been looking at our capital expenditure, and we came in on target, as we said. Quarter-on-quarter, 7% increase in gold production, and all-in sustaining costs remained static. Despite the challenges, this is year-on-year, we had a 3% increase in the gold production. You can see the gold price there is 5% down in rand per kilogram terms. In, of course, dollars per ounce term, 19% down from $1,603 down to $1,299. That's quite a dramatic drop. Cash operating costs, fairly static, down, of course, in dollars, and that's, if you look at the bottom line, you'll see the exchange rates there. Underground grade increased. I've got a graph on underground grade. So all in all, of course, we're quite satisfied with the year. As I say, the challenges were fairly abundant on some of our bigger operations. However, with the low gold price, we did get a lower revenue. Great improvements year on year, quite a pleasant change, and looking forward, we're being, I think, slightly more conservative on our grade. So going forward, we're looking at somewhere between 4.7 and 4.8 grams a ton for the next year. All-in sustaining costs, there's that decline of 4% and 18% in dollar terms. We have to continue to focus on costs. We'll continue to focus on costs during this next year. And the intent is to come down, get the costs, all-in sustaining costs down even further.
Looking at the cash flow statement there, extracts from it, as they say, cash is king. You can see our cash flow from operations was over 2.5 billion rand. And you can see that number is just a little bit more than the total capital figure, about 4 lines down. So that capital is sustaining capital as well as growth capital. So we've been able to sustain the business, pay for the growth capital. And the only additional item you see, the exploration expenditure, mostly in Wafi-Golpu, and that's really investment in Harmony's future. That leaves us with a net debt of 1 billion rand there. The revenue line, quite importantly, Graham has spoken about the increases in grade, increase in production. We've also had an increase in sales, ounces sold up year on year, and we've been able to limit the effect of the price decrease year on year, the gold price decrease to just 1%. So 1% down on the revenue line. Moving to cash operating costs, 4% increase year on year, and that's really a testament to our operational colleagues managing the costs very well, particularly labor cost year on year only up by 2%. And contracting costs year on year up by only 1%. Further down the income statement, you see the amortization expense. That's roughly in line with the increase in production. The impairment charge that we flagged to the market last week, that is really largely the Phakisa impairment that we told you about. And that is really annual change on the life of mine plans, and that we've taken the decline out, but it's also important to remember it's a number of other factors. Gold price assumptions, cost assumptions, inflation assumptions, and also cost of capital. Cost of capital, we've been using higher discount rates this year than last year, in line with market parameters. And because Phakisa is still a relatively long life mine, it is quite sensitive to the rate at which you discount those cash flows. Then the exploration line. As we said, it's mostly expenditure on Wafi-Golpu, a little bit else in that region as well, and it's really down year on year because the drilling program has sort of largely completed during the current financial year, and the studies are still going at full steam. Taxation line shows that credit 279. That's a little bit unusual. And what that is, remember, in the gold industry, we've got a gold mining formula for tax. So we calculate deferred tax by estimating the average life of mine tax rate that we will have in each of our legal entities, and that has come down year on year, resulting in that credit. Leaving you with a net loss of 1,270, but importantly positive headline earnings of 26 cents.
From what you see in Herman's presentation, I mean, we have got financial flexibility. We continue to invest in our assets, and throughout this lower gold price, even in exploration, obviously we are highly geared to the gold price. In our planning, I think we are really positioned to deliver those assets that we had problems with last year. We focused on, so Doornkop, Phakisa, Kusasalethu has got a lot more focus. Much more optimistic about where we are. We're giving some guidance for next year, around about 1.2 million ounces. We've given a range of all-in sustaining costs there, 410 to 430. And if you use a exchange rate of 10.50, that's the gold price range you get to in our all-in sustaining costs. We intend to continue to develop Golpu during this year. During this coming year, the expenditure is going to be fairly low. Herman was talking about drilling. Drilling really takes up a lot of the costs when you look at exploration. Remember that most of the costs on Golpu have been exploration and not capital. And so during the studies of next year, the costs are going to be fairly low, with the focus on safety, safe, profitable ounces, and safety being our number one value. We believe that this mine, Golpu, will be robust at any gold and copper price.